incredible just to see how quickly the market narrative has changed from expecting a rate cut in June now to some economists saying perhaps not at all this year. You've been in the seat that Powell is in, different country, India, but still I'm curious how you think he navigates this complicated scenario that we're in, which is hotter economy with inflation remaining much higher than expected, and at the same time, rates also staying higher, the impact that could have on consumers.
Yes, I mean, clearly what's happened is we've had three strong readings of inflation. One you can dismiss, certainly the January one, but the next two basically suggest inflation is not coming down. In fact, it's going up. And if you look at the measure that the Fed has looked at most closely, which is the super core measure of inflation, taking out housing, it's gone up at an 8.2% rate over the last 3 months. So this is something to worry about. Is inflation coming down steadily as it seemed at the end of last year, or is it having a new set of legs and moving up? So my sense is, they're going to do what they did, which is watch and wait. But, you heard, New York Fed president talking for the first time about potentially rate hikes. I think that's still some ways away, serious talk about that. But clearly, the kind of rate cuts that were expected are off the table. Certainly in the next meeting, they have no more news on inflation or the labor markets. And it's likely they will continue pausing. But how long they will pause is now very much in question.
Tom, Professor Rajan mentioned John Williams, New York Fed president, who did just mentioned rate hikes, but he did said that's not his base case. But even the fact that he mentioned it, you saw the 2-year move to around 4.99%, which is a high for this year. You still have this notion that stocks can continue to outperform if rates stay high. How long do you think that theory will last?
Well, I think it's going to be valid as long as one of several things happens. One is that as long as the economy remains resilient and robust, and so far earnings have actually been coming in quite good. I mean, we're only sort of at the start of earnings season, but already Q1 looks good. And I think the second is that inflation, I think inflation really has a bifurcation taking place, because even as the professor cited Supercore, the reason Supercore is annualizing at 8% is auto insurance. If you took auto insurance out of Supercore, the long-term average is around 2.7, and it's actually annualizing at around 2.7% right now. So the biggest driver of inflation are the two stubborn components of auto insurance and shelter. So I don't know if Williams really wants to be raising interest rates or hiking just because auto insurance rates are high. And I think the third thing to keep in mind is that we don't really need the Fed to make, 3 cuts. I think the one risk to markets would be that the inflation is accelerating to the point where the Fed has to hike and therefore really weaken the economy. I think that's still very much a tail scenario, but that's the one, of course, that would unsettle markets the most.
Professor Rajan, how critical is China's recovery to global economic performance?
Well, it certainly is very important, right? China has been the engine of global growth for a long time, pre-pandemic. But I think it's also important for, the reflationary forces we're seeing. I mean, if you look at commodity prices, they were largely dead in the water for the last year because China wasn't performing up to expectations. As Chinese growth news is getting better, you're seeing some commodities perk up. Certainly, you're seeing copper pick up some in recent weeks. So my sense is that the deflationary effects of China, which have been substantial, especially on the goods side, may abate a little bit if Chinese growth picks up. And of course, it will also add to global demand, which is important.
I feel like we've hit kind of a volatile time ahead of earnings. Next week is going to be great in terms of earnings, because I think earnings are going to give us a better picture. But for the time being, we've kind of hit this air pocket. We're trying to figure out where rate cuts and how many rate cuts are going to occur this year. I'm kind of getting into this camp of maybe no cuts, and I don't think that we need cuts. that's because we have better growth. Especially earlier this week, we had the IMF revise global growth higher to 3.2%. We had better China GDP growth at 5.3%. Here in the States, we're running at about 2.9%. And so that all of this growth, this dynamic is keeping inflation elevated. And so the Fed doesn't really have to do anything. But all of this means that we're going to see better earnings. And so that's why I'm looking forward to next week. And we had some good earnings even this morning with D.R. Horton.